If you're looking for ways to grow your wealth over time and take advantage of the power of compounding, then you're in the right place. Compounding is a remarkable concept that allows your money to work for you, generating returns that can snowball into significant wealth accumulation. By reinvesting your earnings, you create a cycle of growth that can multiply your initial investments several times over. And the best part? You don't need a fortune to get started. Throughout this video, we'll be diving into different compounding assets that have proven to be effective in building wealth. Whether you're a seasoned investor or just starting, there's something for everyone. But remember, compounding is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. The key is to start early, stay invested, and let time work its magic. By understanding the principles of compounding and strategically investing in these assets, you can set yourself on a path to financial freedom and long-term wealth accumulation. Alright, let's jump into it. Join us as we explore the 8 best compounding assets to start investing in. But before we get started, let's quickly recap what compounding is and why it's such a powerful wealth-building technique. Compounding is a financial concept that involves reinvesting profits, dividends, or interest earned on an initial investment to generate further returns over time. It is a powerful tool that allows individuals to accumulate significant wealth by taking advantage of the compounding effect. This effect is derived from the ability to earn returns not only on the principal amount but also on the accumulated returns. In essence, compounding can be compared to a snowball rolling down a hill, gradually increasing in size and momentum as it accumulates more snow. To fully grasp the potential of compounding, let's consider a practical scenario. Suppose you have $10,000 to invest in an asset that generates an average annual return of 8% over a period of 30 years. In the first year, your investment would grow by 8%, adding $800 to your initial $10,000. This brings the total value of your investment to $10,800. In the second year, the 8% return is applied to the increased amount of $10,800, resulting in an additional $864. The total value now stands at $11,664. This process continues, with the compounding effect accelerating over time. By the end of 30 years, your initial $10,000 investment would have grown to approximately $100,626. This remarkable growth is a result of compounding, as the returns earned in previous years continue to generate more returns in subsequent years. The key factor that amplifies the growth potential of compounding is the reinvestment of earnings. Unlike simple interest, which only applies to the principal amount, compounding enables investors to earn returns on both the principal and the accumulated returns. This compounding effect can significantly boost wealth accumulation over an extended period. Now that we have a good understanding of compounding, let's explore the 8 best compounding assets that have made wealthy individuals successful. Number 1. High-yield savings accounts. High-yield savings accounts are bank accounts that offer a competitive interest rate compared to traditional savings accounts. They are the easiest compounding asset to start investing in, as they don't require a large upfront initial investment. Although the returns may not be as high as other investment options, they provide a safe and easily accessible way to compound wealth. Number 2. Stocks. Investing in stocks and equities is a popular long-term strategy for wealth generation through compounding. Historically, the stock market has outperformed most other asset classes over extended periods. By investing in a diversified portfolio of fundamentally strong companies, you can harness the power of compounding. Stocks have provided average annual returns of 7% to 10%. Number 3. Dividend-paying stocks. Dividend-paying stocks are shares of companies that distribute a portion of their profits to shareholders in the form of dividends. These stocks offer the potential for capital appreciation, regular income, and passive income, making them attractive compounding assets. By reinvesting dividends, investors can accelerate the compounding effect on both income and capital gains. It is important to consider factors such as dividend yield, payout ratio, and the company's financial health when selecting dividend-paying stocks. For example, if you invest $100,000 in a diversified portfolio of dividend-paying stocks with an average dividend yield of 3%, you can expect to receive $3,000 in annual dividend income. Over time, the compounding effect becomes evident, and with an average annual stock price appreciation of 5%, you can gain substantial growth earnings of $278,647 over a 20-year period. Number 4. Real estate. Real estate investments, particularly rental properties, can generate consistent cash flow, and property values tend to appreciate over time, offering an attractive opportunity for compounding wealth. Rental income generated from properties can be reinvested to acquire additional properties, further diversifying your real estate portfolio and increasing potential returns. Real estate investment trusts or REITs also provide an opportunity for passive real estate investment and compounding. For example, if you purchase a rental property for $200,000 with a 20% down payment and obtain a mortgage for the remaining $160,000, and the property generates an annual net rental income of 6% or $12,000 with an average annual property value appreciation of 3%, the total return on investment after 20 years could exceed $500,000. Number 5. Bonds. Bonds are debt securities issued by governments and companies to raise funds. While they tend to offer lower returns compared to stocks, they are considered safer investments. Bonds provide a regular income stream through interest payments, which can be reinvested to compound wealth. By reinvesting the interest, investors can earn interest on their interest, leading to compounding growth. For example, if Mark invests the $100,000 in a bond with a 5% annual interest rate, and the interest is paid annually, assuming Mark reinvests the interest each year at the same 5% interest rate, his investment could compound to a higher value over the bond's maturity period. Number 6. Precious metals. Investing in precious metals like gold and silver can be a strategic addition to a diversified portfolio. Precious metals have a historical track record of retaining value and serving as a safe haven during times of economic uncertainty. Although they don't generate regular income like stocks or bonds, their value tends to appreciate over the long term. It is recommended to allocate a small portion of one's investment portfolio to precious metals as a hedge against inflation and market volatility. Number 7. Index funds and ETFs. Index funds and exchange-traded funds, or ETFs, are investment vehicles that track specific market indexes. They offer diversification across a broad range of assets, allowing investors to benefit from overall market growth. By consistently reinvesting dividends and maintaining a long-term investment horizon, investors can take advantage of the compounding effect offered by index funds and ETFs. For example, if you invest $20,000 in an index fund with an average annual return of 7%, your investment could potentially grow to approximately $67,275 over 20 years. Number 8. Retirement accounts. Contributing to retirement accounts such as 401ks or individual retirement accounts or IRAs offers tax advantages and an opportunity for compounding growth. By consistently allocating a portion of your income to retirement accounts, investing in a diversified mix of assets, and taking advantage of tax deductions, you can compound wealth within a tax-efficient framework. For example, by contributing to a 401k and benefiting from employer matching contributions, an individual's initial investment could potentially grow significantly over time. Compounding offers several benefits, including exponential growth, passive income generation, mitigation of inflation, and psychological benefits. It is a powerful tool for wealth building that requires time, discipline, and a long-term perspective. By starting early, diversifying investments, and reinvesting earnings, individuals can unlock the potential for long-term wealth accumulation.